reciprocal tariff announcement by US President have given negative surprise to the world markets as the quantum of tariff was quite high compared to expectations. The so-called tariff tantrums are raising concerns. They have sparked fears of a global growth slowdown, and the potential for retaliatory measures by other countries could lead to a full-blown trade war. This uncertainty is fostering a risk-off sentiment across the globe. In response to these American measures, other countries have begun taking counteractions. We are seeing varied approaches. Many are pursuing negotiation channels, while a few have already moved towards retaliation. With the situation developing so rapidly, however, the actual final outcome remains very difficult to ascertain. Turning to the domestic front, the assessment for India suggests it's likely to be less impacted by these tariffs compared to others in the region. Notably, the government of India has already initiated discussions with the US government. The aim is to negotiate and secure an agreement designed to minimize any potential negative effects. On the positive side, however, there is a view that this situation puts US economic exceptionalism at risk. The increased odds of a US slowdown have contributed to a recent fall in the dollar index and US 10-year Treasury yields. Now, this kind of environment typically bodes well for investment flows into emerging markets. India, being a relatively higher growth country with stable macro, should be a beneficiary of the same. Recent corrections have made valuation of large caps to fall below the 10 years average on 1-year forward basis, while mid and small cap indices still trading at premium with pockets of opportunities seem to have emerged. The temperature gauge index remains in the fair value zone. Equity markets gave up the gains of March 2025 as imposition of reciprocal tariffs led to heightened volatility and risk-off sentiments across the world. Concerns over possibility of global slowdown, retaliatory tariffs by countries leading to full-blown trade war added to the uncertainty. Domestic front, India is likely to be less impacted from the tariff in the region. However, economy is likely to be impacted, few sectors directly and others indirectly. Government of India has already initiated discussion with US government to negotiate and strike a deal to minimize the impact. On the positive side, signs of a US slowdown have led to a decline in dollar index and US 10-year yields, conditions that have historically supported flows into emerging markets. India, being a relatively higher growth country with stable macro, should be a beneficiary of the same. However, this time it may face competition from China for the flows. Recent corrections have made valuation of large caps to fall below the 10-year average on 1-year forward basis, while mid and small cap indices still trading at premium with pockets of opportunities seem to have emerged. In such a scenario, while uncertainty over tariff concerns prevails, improved margin of safety in terms of valuation, risk-rewards look favorable from long-term perspective. Considering the recent corrections, if equity allocation is lower than desired levels, investors may increase allocation by implementing a lump sum investment strategy for hybrid and staggered approach for large cap, flexi cap, mid and small cap over the next 2 to 3 months with accelerated deployment in the event of a meaningful correction. Actions by RBI on rate cuts and liquidity have resulted into steepening of yield curve. Hence, in our view, fixed income portfolio could be overweight on accrual strategies. With the evolving interest rate scenario, in our view the duration play is in its last leg and long-term yields to remain higher for longer and hence duration can be exited fully. Actions by RBI on rate cuts and liquidity are likely to result into steepening in yield curve. We recommend fixed income portfolio to be overweight on accrual strategies. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 30% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies, and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long to short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed-income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. Gold remains the safe haven during such uncertain times as seen historically. Potential INR depreciation due to retaliatory currency measures by China also bodes well for the domestic gold prices.